Hi everyone, welcome back to the second part of the conference. It's now my pleasure to announce the first speaker of the afternoon. It's Dr. Rüdiger Filbry, the head of the financial institutions practice of Boston Consulting Group and the senior partner and managing director in the firm. He holds a degree from the University of Regensburg and from Aston Business School in the UK. Dr. Filbry, we're all excited to have you here and the stage is all yours. Thank you very much.
Okay, so thank you very much for inviting me today. It's a pleasure to talk to this conference, and I'm excited to talk about such a large group of interested professionals, politicians, and students. The question was, when I prepared for this meeting, can the financial industry ever be stabilized? I'm willing to give an answer, but it takes 5 or 6 minutes from the beginning. I'm optimistic, though, if I may start with this. The overall theme of my presentation would be about the future of banks in Germany. So what do the last and recent things and developments mean for banks in Germany? And from our perspective, it's time for strategy for German banks. German banks are confronted with many, many themes, many of them contradictory. Banks are losing confidence of their clients. We have a huge amount of regulation coming up. Infrastructure is rotten. I come back to that later. Clients lost trust in their banks. What we see is shrinking markets. We see less revenues year to year. So the situation is very difficult and very complex, and we, together with our clients, try to navigate them through, and I'm happy to share some of our thoughts and observations today. It would be great if we can have some kind of discussion or Q&A, probably after the session if this is such a large group, but if there are any questions in between, please feel free to raise your hands and shout at me and ask the question. So it's a very complicated situation. The future of banks in Germany probably is determined by 5 points. First of all, we see long-term changes in frame conditions. That's one of the most strongest change we see. Frame conditions meaning the level of interest rates and regulation. These are the 2 main points on this issue. We come back to that later. This is going to see and to come to an extended phase of transformation. This phase of transformation started in 2008, so it's now 5.5 years if you take the bankruptcy of Lehman at the end of 2008. Maybe it started even in 2007 in Germany with the first weakening of German banks, but on a global basis definitely in 2008. So we are now 5.5 or 6 years down the road. We believe this transformation is going to last for another 10 years at least. What is important is the third point. We think that banks need to more focus on customers and clients. Banking has to be more focused on the retail business and on the client side, and I'll show you what we believe is important for the banks. Then, fourth, we need a quantum leap in productivity. Overall, the industry is not cost efficient. We see that other industries developed a complete different culture of productivity and cost efficiency over decades. So banks have to adapt to a new environment regarding cost efficiency. And this will not come overnight. If you take, I have examples from the automotive industry or the chemical industry. If you take these industries, they have been competing on a global basis for decades virtually. German banks did not. And of course, finally, new strategies are needed. So banks need new strategies to cope with all these problems we see. First of all, maybe we should set the scenes. What we expect as BCG is a relatively stable economic frame conditions. We expect the Eurozone to stick together. We expect the Euro to be continued. We expect moderate growth in the Eurozone, a little higher in Germany next year, but rather moderate growth over the next coming years. Moderate growth in the US. US, we might be wrong, taking the numbers in the last couple of weeks. Maybe US might come in stronger, but that's very little influence on German banks, basically. We expect, in general, low-term interest rates, despite the rise at the long end in the 10 years plus in the last 6 months, and that I assume that they are going to raise a little, a couple of dozen basis points probably in the next 1 or 2 years, but we expect in general a low interest rate environment for the next decade at least. We expect low unemployment in Germany and no external shocks. That's our perspective, and that's how we believe a strategy should work. The new normal. The new normal brings many differences we haven't seen so far. And if you want to develop a strategy for a bank or any industry or any client or any company, you have to take into account what is happening. We believe that some kind of V-shaped recovery after a recession will turn out to an L-shaped recovery. So a deep recession used to be followed by a strong rise in growth. We do not think that this is going to come. We see a deep recession, but a rather stagnating or very limited growth, especially in the Eurozone and Germany. So from V to L is one of the beliefs in the change in the frameworks. Regulation is the key, and I'll come back to that later. Regulation is changing. The regulators were focusing on capital and liquidity. Now the complete regulation issue is different. Regulators think about too big to fail. Regulators think about bank separation, as the Likan proposal from 1.5 years ago, and regulators think about bank wills. So what's going to happen if banks are not going to survive? I don't know whether any of you had the chance to read the latest recommendations by Mr. Barnier. He's the member of the EU Commission who is in charge of proposing the next banking regulation regarding separation of banks. It came in much softer than many expected, much softer than the Likan proposal has been. I don't believe this is the end of the game. As I said, it's 10 years to come down the road, and we are on page 4. So the question to your answer, can stability ever achieved, is on 8. It takes a little more. I don't think this is the end. I'll come back to that later. Banks had traditional competition. We saw traditional competition, banks versus banks, or banks versus intermediators. This is changing. There's an enormous amount of innovation around the industry. It's not seeable for many of us. I quote one, I don't know who said it first, that the last innovation in the banking industry was the ATM. I think that's complete nonsense. I have a couple of examples on here. It's not prominent, but there's an enormous amount of innovative power in the industry. We don't know yet what is going to come out of it. IT is very important. Everybody who is in the banking industry has to have a deep knowledge about information technology. I spoke about rotten infrastructure. We had federal elections in Germany in autumn, and they were talking about infrastructure and the need to invest in German infrastructure. In general, I think banking IT infrastructure is much worse than what we saw regarding the infrastructure discussion in Germany in last autumn. So there's an enormous amount of money to be spent. Not all banks are going to have the money to spend it on this infrastructure. And last but not least, we had a stable, predictable environment in the last 20, 30, whatever years. This is going to change. So banks have to become much more flexible in the future. So this looks like a perfect storm, and from my point of view, it is really a perfect storm for banks. Enormous amount of regulation, enormous investment needs, distrust on the client side, and total uncertainty what's going to happen with their traditional business models. I spoke about regulation. We see a wave of legal and regulatory changes is roiling the financial sector. If there's one number you take away, or 2 or 3 numbers to take away from today, is the number, the 100 in the middle of this slide. If you take a look at it, I'll explain to that. We see on the left-hand side the number of regulations banks are facing on a global basis. That used to be, in 2009, about 10,000 on a global basis. Last year, it's probably 25,000. That means 100 changes a day in 2013. So a bank operating on a global basis has to cope with 100 new regulations each day. And this is a complete nightmare. I can tell you, this is a complete nightmare. And whenever you read in the newspapers banks about suffering from regulation, this is the reason for that. And it's understandable if you take a look at the turmoils we have seen, at the hundreds of billions of dollars in euros taxpayers have invested in their banks, especially in the Eurozone and in the United States. Of course, it's reasonable for politicians to come back. We see the return of the politician in the banking industry. This is going to be a much more regulated industry than it used to be. So the industry has to face with a completely different amount of regulation, but it did so before. You just have to take a look at a little longer perspective. So now 5, we come to 8. What are regulators doing? Of course, we are talking about capital and liquidity requirements increasing, larger capital buffers. We see that over-the-counter business is going to be regulated, right? So we see things about separation of banks. That's what I was talking about, the Likan proposal or the latest proposal of Mr. Barnier. We see wind-down plans obligatory for banks, and it's changing. What is changing? In the former times, bank had to write write-down plans and hand it over to the authorities and the regulators, and whatever was done was there. When the regulator today is now able to understand it, the bank is going to be separated, that at least in the separation committee. So it's really changing about the influence. One day, who knows, one question, just one question from my side. The telephone prefix 0228, what country in Germany is that? Bonn, yeah. I once talked to a very senior guy in risk management at one of the leading German banks, and he said, this is so different these days. And I said, why? And he said, you know, when the phone rang about 5 or 8 or 10 years ago and I saw 0228, I said, oh God, I don't care about these. Maybe I'll pick it up every other time or every third time. And today we have 500 people working for them. So it really changed from not picking up the phone to have enormous amounts of internals, lawyers, accountants, consultants, preparing for stress tests, preparing for asset evaluations, and so on, balance sheet evaluation, which is currently going on. So it changed a lot. And of course, and that is just starting, shadow banking and transparency on currency trading. I don't know whether you know that, maybe a different number. Each day, over $5,000 billion or currencies are traded around the globe. That's 2.5 the size of the German GDP a year. Daily trading of currencies, over $5,000 billion, sorry. So, and we saw questions in the newspaper already. But I'm getting a little carried away on the regulations, so let me continue with this. If earnings are coming down, if costs are going up, if capital is going up, profit is going down, and profitability is going down, and it's going down large scale. This is now page 8. I come back to the answer of your conference, of the initial question of your conference a little later. What we see here is really the long-term perspective on the United States, I have to admit. It's less prominent for the Eurozone. We see profits in the banking industry, that's the dark green line on top, and the real industry, real corporate profits, that's the blue line across the orange dotted line. What we see at the beginning of the 90s, the beginning of the deregulation in the United States, and strongly in the UK, and 10 years later in Germany, exploding profits in the financial industry. It's from, I don't know, about 150 on the index left-hand side to 1,000 in 20 years. So it's 10 times the profit it used to be 15 times ago within the financial industry. And then we see the enormous drop, that was 2008, and it has risen again due to measures, especially in the United States and from the Fed. But we believe this disproportion between profits of the financial industry and profits of the real economy is not going to last. And if you go now to the left-hand side, which looks very boring, it wasn't though since 1930. So between 1930 and 1985, 90, whatever you take a look, profits of the banking industry and the real industry somehow grew quite in parallel. And there were shocks in this period as well. Second World War, you saw the Bretton Woods, you saw the decoupling of the dollar from the gold in the early 70s, 72. So there had been external shocks in this period as well. But from my point of view and our point of view, financial stability has been achieved after the worldwide banking and financial crisis at the end of 29-32. So what we believe is that regulation in the early 30s, especially in the United States at this time, achieved financial stability for 50, 60 years. So that's probably a long period if you take a look back in history and what happened in the Netherlands and early on. So human beings tend to be a little weak on the financial side, and there's going to be speculation afterwards. But I believe financial stability can be achieved. And looking back at what I first said, with the enormous amount of regulation coming into the world, Europe and Germany, I believe financial stability can be achieved, and I believe we are on a fairly stable way. One last thing on this side is, we spoke about a regulation tsunami, or roiling the industry. So, and when I had a discussion with politicians in Berlin about that, they said, it's not really a tsunami. I said, so what do you believe? And they said, it's a flood, but it's a flood that's going to stay. So we see it's not a tsunami coming and going back, but it's a flood, and it's going to be very high, and probably, I think they're right. Markets have lost confidence in banks. The return of the banking industry is horrible, of course, in the last 5 years, and they are not earning the cost of equity, however you calculate the cost of equity. I'm well aware that it's very difficult to give a number on the cost of equity, but it's not an industry anybody would invest on in these days. So, I said that we are going to see a transformation, and this is the BCG transformation agenda for German banks. It's basically 3 periods we're going to see. We are now at the end of the stabilizing period. Afterwards, there's going to be a regain of health and then return to growth, but it's a difficult journey. What's happening now is basically deleveraging and steering. Banking are reducing their balance sheets. One example, when Commerzbank took over Dresdner Bank in August and September 2008, not the perfect time for a large takeover, both banks had a balance sheet of 600 billion euros. Commerzbank this year has absorbed the 600 billion euros of Dresdner Bank. So these 2 banks, out of these 2 banks, one disappeared, looking at the balance sheet. Or for example, if you take a look at all of the balance sheets of the large Landesbanken in Germany. This is a very special situation in Germany, but overall they are generally halving or disappearing. WestLB had a balance sheet of 500 billion euros, is gone, and others are halving. So this industry is shrinking dramatically, really dramatically. And local optimization means cost reduction, rather tactical cost reduction we are seeing. All of the banks are having cost reduction programs and stabilizing of profits in order to survive for the next quarter, half a year, EBA stress test, balance sheet stress test, whatever. So people want to be on the safe side with high capital ratios and low volatility. Those who survived this period, and not all survived, I already said a couple of names, those who survived have to take challenges in the second phase, regain health. Then we definitely need more efficiency on the cost side. What I said about IT infrastructure, we need an industrialized world in the middle and back office of banks. This is much worse than it's in many other industries, and banks can learn a lot from other industries. And the complexity in banks is in general not much more than in other industries. So we see huge chances for banks really to optimize their cost structure, but also the necessity to do so, because otherwise they will definitely lose on the client and customer side. And last but not least, afterwards, those who survived this again and managed to develop products, there's a small part of banks who are going to return to growth on their own, meaning to see attractive client segments, attractive customer segments, and partially growing in a stagnating or even shrinking market. Don't count on me on stagnation or shrinking or 1% plus or 1% minus. But the old game was about 5–10% growth in revenues every year. Every business case was built on growth expectations. We are not going to see that anymore. So at the final phase, we're going to see regional banks with an okay profitability, I would say. Not very prominent, but they are going to be there, of course. You all know regional banks. We see local players on the mid-sized scale, and we probably see specialized and global players who are earning their cost of equity. But this is now 5 to 10 years down the road. But what we see and discuss with our clients is that you have to prepare for this journey. And this is going to be what we see. Some are sinking, have sank already, or are going to sink. Some might floating, and the best are able to row or to surf. And I'm not sure about anybody who will be able to surf in the German market. I think to establish a bank that is rowing quite hard is a large success for many we have seen here so far. Let me take 2 minutes to take a look at Japan, because we have to try to learn from what happened before. And when I took back a look at the US, we went back to 1930. Japan is not that far away, and there might be parallels. What happened in Japan? We had the real estate bubble in the 80s, at the end of the 80s or 1990, it burst. What happened in Japan afterwards? Basically, at no speed, zero interest rate. A couple of years from 8 down to 0, now for nearly 20 years around 0 interest rate. Very little inflation, about 0 inflation, you see that in the middle of the chart, and 0 growth. So this is not the ideal situation. What happened in Japan, unfortunately, and there we are going to see a difference, they did not recapitalize their banks. So that was the discussion about the zombie banks in Japan. So they had very weak banks in the 90s, and the banks were not able to give any growth impulses on the industry. A couple of other differences are there as well. Japan is aging faster than any other country in the world. They are very strict and limited on immigration. So we see a lot of differences to the United States and some differences to the Eurozone. I'm much more optimistic about the Eurozone than about Japan. But this is the situation on the economic side might not be so different, with very little interest rates, very little growth, and very little inflation. What happened to Japanese banks? They consolidated, on the left-hand side, the number of banks on an index. They halved about. 50% of Japanese banks disappeared in these 20 years. Personnel have been reduced by 40%. That's quite a lot for a complete industry. And still profits are down by 40% as well on the right-hand side. So we saw a consolidation of 50%, a personnel reduction of 40%, and still a reduction in profits of 40%. Usually, especially when you talk to the equity owner of the parts, they believe if you do these kind of dramatic action on the left-hand side and on the middle, that profits are going to be, again, the level it used to be. But Japan had the real estate bubble. We saw in the United States the Greenspan deregulation bubble. That basically means that the industry never came back to the profit levels they saw in the 90s. And that's what we expect for many European and German banks as well. So just 2 minutes excursion on Japan. Stronger customer orientation and innovation. I spoke about innovation and customer orientation. Maybe we see a shrinking market. We expect shrinking revenues, -1%, 0%, whatever. Nobody knows what the future will bring. But with this interest rate and this level of competition we see in the banking sector, we are not going to expect rising revenues. So banks have to make sure that they differentiate their offerings for their clients and that they excel on efficiency. Differentiation means that you need a brand profile to make sure that your clients understand what is different in your offering and that this profile can be recognized by the clients. And of course, you have to know what are really your customer and clients' needs. Not all banks excel in this dimension. Let me show a couple of figures later. And operational excellence is very important. We see a lot of things to be improved in the back and middle office of banks, let me face it this way, to really excel in operational excellence in the next decade, I would say. So there's huge room for improvement. Customer needs. What we see, not only in the banking industry, but at other industries, as we see here, that we need a clear positioning. Who is winning? Luxury wins. Gucci, Porsche, Louis Vuitton, Hermes, Rolex are growing 10%, 15%, 30%. So we see the trading up segment growing fast, even during the crisis. And discount wins. Aldi, Lidl, Walmart's trading down wins as well. And the problem for many banks is they are in the middle and are being recognized as being in the middle. So what we see is the need to position either on the luxury side or on the trading down side. What we see in Germany, of course, as probably many of you have their current accounts there, are the direct banks. On the right-hand side, you see what clients believe, which banks are doing well, and what are their needs. So what they want are fair and transparent prices, convenient channel access, and good products. These are the three dominant needs, and much of it is offered by direct banks, but at costs never to be achieved by a regular bank. So if people who are in charge of the retail business in regular banks have to really worry looking about these figures, because the needs of the new generation of you and those who are even 10, 15, 40, 20 years older than you are very clearly addressed in direct banks, and direct banks have a completely different business model than regular banks with branches. I'm definitely sure that we have too many branches in Germany, and they are cost efficient and on high costs. I definitely believe that bank business model have to change in that direction. On the other hand, the branches are going to have their value still, because a lot of people tend to do business in the branch, but they don't need it for their transaction basis. So the role of the branch has to change, and German banks have to really dramatically evolve on that. What we see is on the right-hand side, who's doing well on the perception. Those are the direct banks on top. It's Comdirect and ING DiBa, well-known and high reputation. And the incumbents like Sparkassen, Genossenschaftsbanken, Commerzbank, Deutsche Bank a little in between, are highly valued for communication, image, and helpful advisory. Unfortunately, these dimensions are not that relevant for the clients. So that's why we see the incumbents are losing clients and are losing profits. And year after year after year after year, this is increasing. And what else we see is with the low level of interest rate, the profitability crash within these incumbents is going to be more intense from year after year. This is about innovation. You all know much more about innovation than I do, as you are familiar with all your colleagues who have gone into startups, either in the United States or in Europe or in Berlin and what so on. This is just one page. We have about 10 pages or 15 pages with new innovative products, services, advisory services. Some of them are even old again. For example, the Square, who is putting a little thing on the iPhone or on the iPad in order to be able to collect data from a credit card in many countries. I saw that in China the other day. It's working. Then you have paper touch payment by fingerprint. It's working. It's in the real world already. Then you see PayPal operating some bumping payment through iPhone. So what is really is there are innovative processes. Nobody knows which of them is going to survive. 90% or 95% are going to die, but one or two are going to become big and are going to take the largest chunk of the revenues of German banks. For example, house financing was an extremely profitable product for 50 years for German banks. Today, this is the hardest phase ever to sell house finance profitable in Germany, and people tell their bosses, we have to sell it at this price at a very low or even negative margin because we have to stay the anchor client, anchor bank for our client. We are not earning money on that anymore. Unbelievable 10 or 20 years ago. Same for savings. 1-year savings, 2-year savings, with the transparency on the internet and the quick movement around, all the profits of banks in this part of their profit scheme is gone. So it's really dramatic, the decline of the revenues. We see new advisory models. Fiedler Bank is a German bank. They offer peer-to-peer advisory on investments. We see new channels. We see channels like My Money allows account to be managed through Facebook. So we see social media. We see so many innovative things around the internet and technology. But banks, unfortunately, are not that strong with it. Yesterday, I actualized this site as I showed this half a year ago. Like 2 examples. We see Deutsche Bank, one of probably the most prominent bank in Germany on the one hand side, and BMW and Mercedes on the right hand side. Deutsche Bank yesterday had 37,000 likes, BMW had 15 million, and Mercedes-Benz had 12 million. Half a year ago, there was 50,000 to 11 million and 8 million. I just remembered because I double-checked it. So basically what we see is, on the right-hand side, emotional product offering, products people like and products people aspire and products people they have some strong emotional relevance for. Banking has not. And it's going to be very difficult. I don't have answers for this, but I remember in Germany, we saw an electricity provider telling that Strom ist gelb, I think so, or energy is yellow, something like that. They tried to make a brand out of a commodity. It did not work. So branding a commodity is probably one of the hardest things to do in marketing, and only very few succeeded. And you have to be very sure, and you have to have very deep pockets, especially regarding your marketing expenditure, to make a branded product out of a commodity. And if you take regular finance products for the private and retail clients, it's going to be hard. Quantum leap in productivity. Before we go into the Q&A, we have about a quarter left of the time. Let me give a couple of minutes on productivity. What we saw previously on the left-hand side is that the overall expenditures of the banking industry rose 2, 3, 4% each year. So the general expectation was we have a rise in costs of 2, 3, 4% no matter what happens, but it wasn't a problem because the revenues rose 5, 6, 7, 8% a year as well. That was the expectation. But that's a different industry, of course, perspective. I said when we looked at the automotive or the chemical industry, their efforts were always to gain 2 or 3 or 4% operational excellence. From my point of view, at least largely because they were operating on a highly competitive global market. German banks did not operate on a highly competitive global market, besides Deutsche Bank with their investment banking, of course, and maybe besides one or two of the other banks who are partly disappeared. So this industry is not used to gain efficiency year after year after year, and that has to change. Short term, we see the cost reduction, the need for cost reduction, 5 to 15%. That's what's now happening all around. When you open the newspapers in the last 12 to 24 months, all banks, being it German, European, or US, reduced their operating costs on the personnel side and on the operational cost side. And medium to long term, you need new business models. New business models, you can be very innovative about that. What is the traditional strategic advice we give to players operating in a stagnating industry? You have to take a look at M&A possibilities, of course, because then you can make the use of bigger platforms, you can be more efficient, you can make better use of your investments, so you grow through M&A. That is not that easy in Germany, as we have the public banks, the private banks, and the cooperative, and they're quite separate still. On the other hand, we see that this has been opening and is opening. So we believe is that these pillars are going to be continue for the next years at least, but that banks try to cooperate across these sectors. So in the middle and back office. You see, for example, DWP, which is an operating bank for the Wertpapierservice. That means when the cooperative sector and the Landesbanken own 50% each for a couple of years, and it's working quite successfully. So we see moves and changes, and the leaders of the industry are seeing basically the same figures as we see and see that they have to change. And this is on the right-hand side what we think is necessary. Huge amount of cost reductions all over the place. Billions of euros are going to be achieved. In Germany, less on personnel reductions. In the United States and London, hugely on personnel reductions. Thousands and 100,000 of jobs has been lost in London and New York. Little less in Germany. I'll show you the figures in a moment. One thing in Germany is that the wage level in the banking industry is about 50% above the average industry level. So this is an industry having high remuneration for their employees, and this is going to become under pressure as well, what we are seeing in all the restructuring programs we see. What are the measures? Whatever. You see pay freezes, reduce on vacations, you see bonuses and benefits, weekend work, and so on and so forth. There are a couple of luxury in their usual employment agreements we are not going to see for the future. But of course, in an industry with shrinking revenues, high cost pressure, this has to be addressed as well. This is going for the long term, though. We don't see any revolutions on this side. In the last 12 years, on the left-hand side, it's about 1.5% reduction in personnel in Germany, from 775,000 to 649,000. So it's 100,000, that's a lot, but still for the complete industry, 1.5% per year is not that much. I don't think we see dramatic differences in this, but this is going to be continued. I said 10 years or 12 years from today, maybe 15, whatever. It really depends on how stable the industry is. But of course, this means a complete change as well. So if you take into account reduce of remuneration, you see reduction of personnel, it's going to be difficult for the head of HR to motivate all of you to join banks. So banks have to really get innovative on their HR and personnel and recruiting strategies as well. And it's very important because they need, on the middle management and on top management, new management styles, as we've seen that the industry is changing so much. So from my point of view, it's an industry where the change is biggest, so it's most exciting for managers, but the tasks are imminent as well. So, new strategies needed. I'm a little out of time, I'm sorry. What we see is, and if you take the picture along, in the past, banks could easily go with the flow. You see all these fishes here. It was easy to stay in the flow and follow the rest, and you were successful. And that was for dozens of years, in Germany, in Europe, and in the US. Today, this is the perfect storm. It's really the perfect storm, as I said, with banking crisis, liquidity crisis, complete new setup of regulation, shrinking revenues, new competitors with completely new technology approaches, total loss of confidence of your clients into your business. So this is the perfect storm. What we need for the future is a clear strategy and a clear guidance from top management. I think what some banks are missing is a clear strategy from their top management to see what is our way through this perfect storm and how are we going to operate afterwards. So from our point of view, it's time for strategy, take into account the many different scenarios we are going to expect, take into account that we are expecting a stable environment for banks, but rather uncertainty, and be prepared for a difficult and volatile journey for the next 5, 10 to 15 years. But the next 5, 10 to 15 years are going to be for those who are in the management of banks, or have the pleasure to consult banks as we do, the interesting years since the early 30s. As you remember the page, when after the 30s it became boring in the banking industry again. So maybe banking is going to become boring, I think so, but before that starts, it's going to be extremely exciting. So thank you very much. There are a couple of minutes left for Q&A, I believe. So please go ahead.